So this lesson is going to be on mitigation blocks, which is a type of PDRE metrics or institutional reference points. When traded to, we can engage entries. Okay. We are going to go into chart examples, but let's quickly look into this important fact. We are saying that a mitigation block is a type of order block. Okay. It is formed when price fails to make a swing high or low. Okay. When price fails to make a swing high or low. It can form in trends for continuation. It can form for trend reversal. Okay. It also shows strength if it forms in it shows strength when formed in a trend for continuation, and then when it forms for reversal, it shows weakness in the underlying trend. Okay, that the underlying trend is getting weak and price is about to reverse. So let's look into mitigation block for trend continuation. So you can see that this price action, we are bullish, we've been bullish, and then we have this one candle pullback. It fails to make a swing low. Normally in a bullish trend, we want to see higher high, higher low, higher high, higher low, higher high. In this case, this bearish candle formed, but it fails to pull back accurately to make a swing low. It just gave a one candle pullback and then a continuation. Once we break and close above that candle, you can box it out and extend it in time. Price will come back and recapitalize on it, okay, to continue on the prevailing trend. So you're gonna see this in strong trends. When a trend, normally when it's strong like that, it doesn't make significant pullbacks. It can give just one or two candle pullbacks, break higher, come back to test that little pullback for continuation. Okay, so price tries to, forgive me for this spelling, is price R not T. Price tries to pull back but fails because of strong bullish momentum. So this pullback fails to make any significant swing low, just one candle pullback, break higher, continuation, come to retest 50%, okay, and then boom, that's an entry. Smart money accumulates more buys at the open of the bullish mitigation block. So the open is also at the middle point of the block, or it's also called the mean threshold. 50% of an order block is also called the mean threshold. So as I said, mitigation blocks are types of order blocks. Okay, let's look at this example. We are bullish with strong momentum, high, pullback, high. We fail to make any significant pullback, just one candle, bearish candle, and then we break and close above it here. You can see that this candle quickly retests it and then bought. Price came back to retest the 50% again and then bought. Okay, so price tries to pull back but fails because of strong bullish momentum. So normally after a break in market structure, we expect a pullback to 50%, right? But I see that the momentum is so strong that price fails to pull back. It just gives one candle pullback, then we break and close above that bearish candle. It becomes a mitigation block. Price will come back to it, 50% or the open of it, and then smart money is gonna add more longs to their position. For a bearish example, you see this strong bearish momentum. Price, after a break in market structure here, price should ideally trade back into some zone here, like this other block, to then go down. It fails to do that. It just gives one candle, one bullish candle. We break and close it below here. What it's telling us that price is so strong and it's going down with momentum that it is failing to pull back with significance. Okay, it's not doing any significant pullbacks. So once we break and close below it, you can extend that level in time. You can capitalize an entry on the 50% or the open of it. As you see here, smart money sells short at the mean threshold of the mitigation block, or the 50%. One more example for a bearish scenario. We are bearish, price tries to pull back. We only pull back on two smaller bullish candles. It even fails to go above the previous bearish candle's high. So there is not a significant pullback. Normally a significant pullback should go above a previous candle's high, or a previous candle's low. So if you are bearish, you want to see a proper pullback, this pullback should be well complete if it goes above this previous candle's high, this bearish candle's high. It fails to do that, it just trade within this candle's body, break down aggressively with momentum, extend that level in time, 50% of these two candles. Okay, so sometimes it can be one candle, it can be two candles, sometimes it can even be three, but then it may still trade within the previous candle's body, okay, or range, previous candle's range. So once we trade through it and break lower, extend the level 50% for entry, or open of the entire block for entry. So 50% perfect entry, hits it and aggressively moves down. Now let's look at mitigation blocks in trend reversal. But first of all, we're going to look at the bearish scenario. So for a bearish reversal, you can see that prior to this reversal, we were bullish. Okay, price makes a higher high, pulls back, break structure higher, pull back, break structure higher, pulls back. After every proper pullback like we see here, what do we expect? We expect price to continue to break the last high, right? As you see here, we pull back, we break this last high, make a new high, pull back, break this last high, pull back. After this pullback, we expect price to continue going higher to break this last high. But you can see that we pulled back all right, but we failed to break this high. We failed to continue on the trend. We failed to break this high. So after they failed to do that, and then price breaks this low, okay, this becomes a mitigation block. This bullish candle that tried to go higher, that failed, that becomes your mitigation block. But ideally, we are making higher highs, right? So after every pullback, we should make a new high. But in this case, price fails to make a new high after pulling back. It couldn't break the previous high, the last high here. It couldn't break it. It just stopped here and broke lower. So as I say, mitigation block is formed out of a failed swing. So this whole thing is a failed leg. Okay, it should normally go up to continue, but it failed to do that, so it's a failed swing. Once it breaks lower, this bullish candle becomes your bearish mitigation block. Okay, so let's look at a bullish scenario. For a bullish scenario, prior to the reversal here, we were bearish. We break structure here, pull back, break structure lower, pull back. After the pullback, we expect that we come down to break structure here so that we continue making lower lows, right? Just like we break structure here, sell off, pull back, come down, break structure down, we are pulling back. After this pullback ends, we expect price to continue down to break this low. But what do you see? Price fails to do that and then break structure higher. So it is showing you weakness in this downtrend. It is showing you weakness in this downtrend. So once you see this failed swing and the break higher, you mark these two bearish candles that try to make the lower low and failed. Okay, this should have sold down all the way to make a lower low. It failed to do that. It just stopped there and then broke structure higher. Once you see that, it is telling you that this downtrend is getting weak and price is about to reverse. It breaks up, extend these two candles in time. You can see that price comes back to the mitigation block. So these two candles, the middle point of it, price comes to it for entry. You can also use the first candle, the first candle's opening for entry as well, and then boom, it buys. Okay, so as I said, for continuation it shows strength, for reversal it shows weakness. Okay, let me go back to the bearish scenario. We are bullish previously. Okay, we pull back, make a new high, pull back. We are supposed to make a new high. Price fails to make a new high after this pullback. It just ends here and breaks structure lower. So what you see here is a failed swing. It failed to make a new high to continue. Once it breaks lower, like this, you should immediately know that this uptrend is getting weak and price may possibly what, reverse. And what you see here, after the break of this, we come back to this mitigation block, which is this bullish candle prior to the break of structure, and then sells off.